save some money and you're ready to begin investing. You want to enjoy the profits that are produced by the stock market, you need to invest with a long-term view. Consider the year 2007. That year, the S&P 500 gained 5.5%. Now, considering that the stock market as a whole averages 10% a year, a 5.5% gain doesn't sound that great. 2007 was even worse than you think. That's because from January 1st to November 21st, the stock market gained nothing. The S&P stood at 1418 on January 1st, and believe it or not, it was virtually the same on November 21st. Then from the 21st to the 28th of November, the stock market jumped 5.5%. After that, the market remained flat for the rest of the year. So we didn't have a good year in 2007. We had one good week. If you are one of those investors who jump in and out of the market, you could easily miss out on the 1 week that profits are made. Let's take a look at an example in the more recent past. 2020, the pandemic. 3 of the worst days in market history were in March of 2020 as the pandemic began to take hold. Between February 19th and March 23rd, the market had fallen a total of 33%. Many investors in this scenario get scared. They take out their money while they can and they run. This is a huge mistake. From March 23rd forward, the market had a V-shaped recovery, almost going straight up. By September, it had completely recovered to its pre-pandemic highs, and by the end of 2020, it had reached an all-time high. Trying to time the market is a losing game. So you might think that staying in the market all the time sounds risky. Well, yes, investments do have risk. Bank CDs, bonds, of course stocks. There is no such thing as a risk-free investment. Every investment has risks, and there's no way around that. That's why achieving your investment goals means limiting your exposure to each type of risk. And the best way to do that is through diversification. Imagine you have $25,000 to invest for 25 years. If you choose a 3% CD for the whole amount, your account would grow to about $52,000. On the other hand, let's say you split your 25 grand evenly into 5 piles of 5 grand each. With the first pile, you buy 5,000 lottery tickets, and like everyone else, you lose all of it. With the second pile, you bury it under your mattress and you gain nothing for 25 years. It's still 5 grand. The third pile, 5 grand, you open a bank account at 1%, and your investment will grow to $6,400 over 25 years. With the fourth pile, you buy a U.S. Treasury bond. It earns 3%, same as the CD, and the 5 grand grows to about 10. With your fifth and last pile, you invest in the stock market. You earn 10% per year. Your 5 grand will roughly grow to more than $34,000 in 25 years. Even though you lost the first pile, earned nothing on the second pile, invested in a bank account with the third, a super safe government bond with the fourth, and only gambled in the stock market with 1/5 of the money, in total you have about $3,800 more than if you had invested the entire amount in CDs. These returns are possible thanks to diversification. Now that's an extreme example, but it shows you the basic concept behind how diversification works. It allows you to take calculated risks, and even though some of your money may fall in value or earn a small amount, you only need one part of your money to earn above average returns that can boost the overall portfolio. Surprisingly simple, right? I'm Taylor Bauerle, president of Kairos Private Wealth. We look forward to helping you with any of your financial needs.